All right. Good evening, everybody. Apparently we weren't able to get a decent recording of the Hurley Investments market commentary on February 6th, and it cut off 90% of the webinar that I had recorded. So we're going to do this one again. So just to start out, welcome to the Hurley Investments market commentary, February 6th. Again, just going to go through this fairly quick and just double back on some points that I had made and things we talked about back on the 6th. So, starting out, we had gotten protection on for earnings, and after earnings reports had gone through, a lot of stocks we had been leaving protection on. The point for that was just that our market, is having a hard time deciding. Well, it's going up. It's bullish since the beginning of the year, but it's hard to understand what it is that the market's thinking. What are investors thinking that the market deserves to be bought into? So we'll talk a little bit about that. Here's our market, S&P. As I mentioned, you can see we have a bullish run, but since we've gotten about to this point, beginning of February, the market has kind of been weird. So what's been weird about it? Well, some stocks that have done, as I mentioned, some stocks that have done well on their earnings, really not getting any love for it. And some stocks that have done terrible or just not so great are going up. Some examples would be Apple. Apple was, I think, somewhere around here. Kept heading up way above the 200-day moving average. It's gone a bit sideways since, but sort of odd to see Apple, I guess, given a pass like that by the market. Another example might be, of course, this would be in the future, but here's February 6th. So technically, I'm kind of going into the future, but for this example, Under Armour did amazing. They did amazing on their earnings, similar to other retail brands. I've mentioned before how some of the retail stores have been doing terrible on their earnings reports, but some of the brands have been doing well. And man, this maybe just have been a profit taking after such a huge run up from the bottom of October. A lot of stocks seem to see a sell off even after doing well on their earnings, but probably has to do with the run up they've made over the last 3 months. That's all I can gather, but I guess that still doesn't explain other stocks that have made similar runs and didn't do so well on their earnings go up. So, long story short, why are we keeping some protection on these last week or two? Simply because some things are just not making a lot of sense, and we're just wanting to be a little more protected. um, Talked a little bit about Meta and Baidu. Meta had fantastic earnings, had this enormous jump, but has been struggling to get over 190, 185 really. So the thought there is, even though they've come and make this huge run, they're still trading at an amazing discount. They've been so overwhelmingly just sold off. And the same goes for Baidu. Let's see, let's go back to a long chart here. This is Baidu with a high of up here, 350. And Meta, I think, was up at like 380 at its high over the last few years. Here we are, 384. So, again, nice run up for both of those, but man, still trading at an amazing discount and huge opportunity because these both have just sold off so much from their highs. It's starting to create this spring back effect on both of those. Why is this? Well, Baidu specifically, we have China opening back up in a huge way. They're getting their people back to work. Huge amounts of stimulus are being infused into their economy in the same way we did back in 2020, and we're in the part where we're tapering off that stimulus and debt buying, and our Fed is starting to tighten up. China is the opposite. We're doing also better on our supply chain as they've come back to work. That helps ease up some of the supply chain worries and issues we've had. So for those reasons, that's why we're probably seeing this rise in Baidu. Meta just had an incredible earnings. They just did great. Um, so their run up from October is totally justified. For that account, it kind of makes a lot of sense. So some are making sense, some are not. Baidu, which revised their earnings to the 22nd. They always change those dates around, so you got to keep your eye on them. But Baidu should look amazing. Went over the briefing article for the big picture. I really thought this was interesting. It went over PE ratios, price to earnings ratios. If you take all of the earnings across all the companies in the S&P 500 and you divide it by the price of the S&P 500, you're basically averaging all the companies there together and analyzing all of the price to earnings of all of them. And typically it seemed like before 2019, it was around 19, 20 times earnings. When you ever talk or hear about earnings multiple, we're just talking about price to earnings ratio. In other words, how much are we paying for price-wise relative to how much a company, or in this case, all the companies in the stock market have made on a forward-looking basis. So S&P 500 started the year at 16.7 times forward 12-month earnings. So this is the number we're talking about. And so from what I remember in 2020, it got ridiculous and went in the mid 20s times earnings. That probably, I think, tells us back down below, but that highlights, this 16.7 definitely highlights how much stocks have traded, how cheap stocks have been. Obviously, the lower price to earnings number or earnings multiple number, that means how much cheaper our prices relative to the value a company delivers in terms of its earnings. So pretty amazing. Started the year at 16.7 and we're at about 18.5. So come up significantly. If you don't look at these numbers a lot, that's quite a significant jump in earnings multiples, as a lot of those stocks in our market have risen up quite significantly from the beginning of the year. People definitely seeing some good stocks on discount, and for that matter, some really crappy stocks are being bought as well. So this goes over different sectors of PE ratios. S&P 500 communication services trades at 17 times forward 12-month earnings, hit a peak multiple of 25 times earnings in September 2020. You'll start to see some repeats, as a lot of these peaked in 2020, some of them in 21. Consumer discretionary, this one is outrageous. So trades at 26 forward 12-month earnings, hit a peak multiple of 54 times earnings in July. Why is this one so much more than some of the other sectors? Well, it has to do with Tesla and Amazon, which are regularly the most overvalued stocks in our stock market. Always are trading at a ridiculous earnings multiple. Fact, let me just highlight this by going to FinViz. It tells us a little bit where those are trading at an earnings multiple. So forward 39. There were days Amazon was 150 on their PE, 50 on their forward PE, if I remember correctly. Let's look at Tesla. Uh, 57 on their PE, 37 on their forward PE, which is the numbers we're talking about. But those are pretty high. And just for reference sake, compare that with Apple, 23 times earnings, a lot more reasonable, a lot less expensive. Let's see, let's get back to big picture here. Consumer staples. Let's see. Energy is typically a lower earnings multiple. Doesn't move a ton. Financials, somewhat similar. Definitely can move, but different sectors, suffice it to say, trade at different earnings multiples. You know, those consumer discretionary or the tech sector, those are going to be a higher multiple because people expect a lot of growth out of them. Let's see. Moving along, here's our technology sector, had 28 times earnings at the peak of 21. Compared to the S&P, 26% premium to the S&P and 27% premium to 10-year historical average. Anyways, it goes through a few other ones and kind of comes down here and talks about what it all means. Stock market can go through some fantastic periods where it looks like as if valuations don't matter. What he means by that is the PE starts to get so high and so expensive that it sort of becomes a self-fulfilling prophecy, as if it's not important anymore. Those numbers don't matter as much because, man, everything is just going so well. You know, if you guys remember in 2020 how things were, that's exactly how it's being described. So you start to wonder, geez, how much higher can all these stocks go? Bunch of retail investors are getting into the market. Everybody's kind of treating it like starting to treat it more like, you know, this gravy train, and there's a lot of FOMO, fear of missing out, and money just starts to pile in. Happens a lot of the time at the end of bull markets, such as 2007, 99, 2000, before the dot-com burst, and things just get way too heavy and overvalued, where you're paying so much more price wise for earnings that don't justify it. Okay, so that was the experience for much of 20 and 21, kind of like I just said. Fiscal and monetary stimulus did the driving, along with the persistence of ultra-low interest rates. Those were the reasons why it happened. But everything changed in 2022, and to a large extent, the charts above show that valuations ultimately matter, and that there is a revision to the mean following periods of excess and misery. So revision to the mean, meaning that average, that middle point, that those PE ratios tend to stick to for those sectors, it kind of snaps back to that middle point at some point, whether it will go up higher in those periods of bullishness and then snap back to the mean, or go lower in periods of recession and then later snap back to the mean. Tends to follow those things. That's obviously why it's the mean or the average. And you can kind of see that big boost up here on 2020, and then kind of snapping back here towards the middle. Then he talks about Tesla and Amazon specifically contributing um, to this rally in the first 5 weeks of the year, and the S&P trading at 8% premium to its 10-year historical average. Some pundits suggest it could get as high as 20 times on the multiple expansion, which would put the S&P at 4,500 based on the current forward 12-month EPS estimate of 225. Conversely, we have heard others suggest it could go down to 3,000, or roughly 13 times the current forward 12-month earnings per share estimate, before this bear market finds its bottom. So there, some people thinking it can go higher, some people can go lower, thinking it can go lower. That's kind of obvious. There's always two sides, two opinions, at least, right? Thus far, the momentum has been entirely to the upside in 2023 as market participants have cheered the prospect of the Fed being done soon, raising interest rates while pressing their bets for a rate cut before the end of the year. The momentum, however, has the market trading at a full, if not rich valuation at a time when valuations should matter against a backdrop of a declining earnings estimates. Diverting further from the mean strikes us as something that would be fantastic and excessive, which is also 2020 and 2021, but not warranted in 2023. So this last paragraph, I kind of agree with a little more, which just attempts to bring the market back into reality. And we really don't know about this rate cut before the end of the year. On a year last year that we just continue to see inflation rising and not lowering, which is really the only thing that matters right now, as far as the Fed is concerned. They're more concerned with how the inflation is going up, and less concerned with whether or not they're going to put our economy into a recession and cause a lot of layoffs and such. So again, brings me back to my original point, which is, yeah, these stocks are rallying, and man, we've had everything go up. Some pretty ridiculous up and down and all around in the meantime. Which kind of lends to our issue with the market just really not knowing, not giving us any idea of what really makes sense. We are honestly confused. Confused why some stocks aren't getting the love they deserve. Under Armour, Disney. Some stocks are getting a lot of love they don't deserve. And the stock market as a whole, on this trip that the Fed is going to slow down and even cut interest rates at the end of the year, right now seems ridiculous. Nothing that they've hinted at, nothing that they've said tells me or suggests to me that that's something that they'd be looking at any point, because we specifically just have not seen any indication that inflation is cooling off. We have seen some jobs come down with some of the big tech companies that already have hundreds of thousands of employees, so not a huge big deal. We've had employment numbers continue to do well, which doesn't really help our inflation problem and what the Fed would like to see. So yeah, we just don't understand what is with the um, love that the market is getting. All right, so where will our markets end the week? My bet was higher as it continued to go that way. For the Dow, way overbought on the Williams% R and just touching overbought. So a lot of these bigger swings and bigger movements kind of are tightening up there, maybe starting to go sideways, but still bullish. S&P still bullish. But very ridiculous. And of course, the NASDAQ, fairly similar. And I did point out the other night when we went over these, we have these big, all important crossovers, 50 over the 200 right here. On the Dow, just barely here on the S&P. And starting to get a little narrower and closer on the NASDAQ. Those are all bullish technical signs, and maybe that could be part of what's driving things up, but it kind of takes the drive prior to that for those crossovers to happen in the first place. So yes, I'm not sure. I said up 2% with where our market will end in February. Your earnings coming up. Roku, Vimeo, talked about Under Armour, Disney. Baba was important for, or is always important for helping or hurting Baidu. So we got to keep an eye on that. AMC, interesting to see how the movies might be doing. Certainly has been helping Disney. Econ reports, we've got trade balance, consumer credit. Tuesday, Wednesday, MBA wholesale inventories. Thursday, initial claims, continuing claims, which has been in quite a focus for obvious reasons. And then we got consumer sentiment on Friday and the Treasury budget. How are we looking to trade? Currently running most stocks again with protection, getting ready for earnings by protective puts and full collar trades. We're still starting to add leaps for some positions, Boeing, Baidu, JP Morgan. Next week, this was an old part of a few weeks ago, but we had this on for adding shares to Meta, which and Disney and Bank of America, we already added those. All of those shares, Meta, Disney, Bank of America, getting back on when we sold them off right before the end of last year to do some tax harvesting. and we had timed that to perfection, most specifically with Meta, where we got it on right here on February 1st and had their earnings with this $35 jump. Very good timing there and very fortunate for us. We did put SPY puts on through for the rate hike, but took those back off after the way that it reacted for us. I won't go over too much of these, but I liked this article kind of talking about more on the confusion of that is our stock market and what could be behind a lot of the movement. But go ahead and check those out. I like these ones that tell you how much you'd be worth if you invested $1,000 10 years ago or however long ago. Kind of ridiculous and kind of fun in a way to see how stupid you must feel for not investing sooner. This one is one Kevin sent. He likes these inspirational ones. Sometimes really nice to hear, as so many things tend to be overly technical and pessimistic. So those are some of those. Please read. Hope you guys have had a good weekend, and that the week ahead treats you well. And that pretty much does it for me. And yeah, I guess I can't really ask any questions because nobody's here, but enjoyed going through this with you. And of course, you can usually reach me on the Thursday morning trade findings and adjustments, which is typically where I do my webinars. So please join me if you have the time during the day, during your mornings, to go over stocks and some trades and things that we're talking about and thinking about. And other than that, that does it for me. So have a good one, and we'll see you next time. Take care.